Hey guys, it's Christian, your hometown realtor. And for today's video, we're going to do a comparison. We're going to compare two investments because we want to know after 30 to 40 years, which one would produce the most money. And that is real estate or stocks. But we've got to get more specific than that. We need to set up some parameters. So we're going to use Vancouver Real Estate versus the S&P 500, the 5 biggest companies on the New York Stock Exchange. And we're going to compare over a 40-year time span, which of those investments would leave you with more money. See, there's a lot of debate and discussion about it, and making the wrong decision can cost you a lot of money, can potentially change the course of your life. I do meet a lot of people who think that real estate is overvalued, and I also feel that and meet a lot of people who say it is the best decision you can ever make. Well, let's see. Let's see just from a numbers perspective on which one you'd come out ahead with. Okay, so let's run this. We're gonna have two couples, and we're gonna go all the way back to 1982. We're gonna have Ross and Rachel, who are gonna invest $20,000 in the S&P 500. And we're going to have Chandler and Monica, who are going to take their $20,000 and they're going to put it in as a down payment towards a house. So let's go with Ross and Rachel. And here we are in 1982, and they're going to invest $20,000. That's all they have, and they're putting it into the S&P 500. Now, the reason why we're going to do the S&P 500 is it's actually going to prove to be the best investment for them. We know with mutual funds, there's a 2% administration fee, management fee, and that's going to eat away at their returns. So they're not going to go there. And we also know that stock picking is very hard to do. There's a lot of active managed funds by, the smartest guys on Wall Street, and they cannot even beat the S&P 500. In fact, studies show that over a 15-year period, something like 90% of actively managed funds underperform the basic index. And the reason for that is simply this: it is very hard to predict the future. It's hard to predict world events. It's hard to know who the CEO is going to be 10 years from now, or what new technology, what two kids are working in their mom's garage cooking up the next Google. So it is very, very hard to beat the index. So Ross and Rachel, they're smart. They're going to invest in the index. Now, a couple of criticisms will be, well, hey, you're just buying the U.S. index. Why not buy the TSX, the Canadian Stock Exchange? Well, the TSX is 30 to 40% of the companies are resource companies. They're energy companies. So you're too concentrated in one sector. When you're buying the S&P 500, you're very much diversified, whether it's tech with Apple and Google, whether it's something like apparel with Nike, food, for example, McDonald's, or maybe it's retailers like Costco and Walmart. You are diversified. And the second thing, the big bonus about investing in the S&P 500, in my view, is it's a global. All these companies are international. Right? So they are in Japan, they're in Europe, they're in Australia, not just in Canada and the United States. And the 500 biggest companies on the S&P 500 represent about 73% of the entire United States economy. So you're quite diversified and you got a lot of heft there. So they've made a good decision. And just in case you think otherwise, you can always Google for yourself this bet Warren Buffett did, where he offered to a number of people in the hedge fund industry. He said, look, you can choose any hedge fund you want. I'm going to choose the S&P 500. And I bet in 10 years, my passive investment, meaning just buying a sliver of all the companies, will beat you picking and choosing stocks. And of course, it took them a long time to find someone to take them up on that bet. But when someone did, they got hammered. That person chose six different actively managed funds, and all of them got creamed by the S&P 500. So when you're investing in the stocks, if you're not Buffett, your best bet is the S&P 500. Now, over 40 years, if they had invested $20,000, fast forward to 2022, And the return is going to jump to about $1.7 million. So that's a heck of a jump. So Ross and Rachel here, they've done pretty well for themselves. They should give themselves a pat on the back. $1.7 million is fine. Now, in Canada, however, we've got a capital gains tax. So half of that is taxable, so that's going to be $850,000. And of that, kind of rule of thumb, we can expect they're going to pay about $425,000 in taxes. So from that original $1.7 million, we need to take off $425,000. So, let's be good. We're going to just round it off to 400. They walk away with $1.3 million in cash. Okay. Now, for the purpose of this video, we're not going to do currency conversion. So that would be 1.3 million if it was in US dollars. Okay. Now, and let's visit in with Monica and Chandler. And Monica and Chandler back in 1982 are going to take their $20,000 and they're going to invest it towards a down payment in a house. They want to have a family. They've got twins on the way. So having their own house, a little backyard, it's really important to them. So they buy a house. Now, you got to understand, back in the early 80s, sort of a 20% is the going standard for a down payment. And remember, one of the big bonuses of real estate is that you get to use leverage. You can lever up, meaning with 20% down, you can buy a $100,000 house or home. And now there's a few other things that are going to, over the next 30 years, Monica and Chandler are going to be chipping away at their mortgage, making those payments until they owe nothing on the mortgage. So they own the house, what we would say clear title. There's no financial charge. There's no mortgage on it anymore. And at the same time, here's the big bonus, the value of their home has shot up. Now it's taken 40 years, but if you follow the blue line here, you can see that as we move through the 2000s up to 2022, the value of their home is over $2 million. Okay, and that's an average house in the greater Vancouver area. And we're going to assume that they have a very average house and they live on Vancouver's east side. So they've made over $2 million. Now, here's the big benefit of owning a home in Canada. And if there's one bone the government throws you, it's that there's no capital gains. So if Monica and Chandler are downsizing now into a condo or maybe even going into a senior's home, they are going to pocket that $2 million. Now there's going to be a commission on that, so you might knock off about $60,000. But they're still going to come away with, let's say, about $1.95 million based on the average value of a home. And that is without any capital gains tax. Now, remember too, if they were living in a 2-level house and they had a separate entry, they could potentially here have collected rental income. And if they were, let's say, collecting rental $2,000 a month for 12 months of the year, that's $24,000. That's $200,000 over the last 8 years. That's $400,000 over the last 16 years. So, but we're not going to count that $400,000. That's another bonus. We're going to set that aside. But I think if we did just a pure comparison here, and we're going to assume that they invested in Canadian ETFs on the stock side, I think it's pretty much a slam dunk here. On the detached side, you're coming away with about $1.95 million, and on the stock side, you're netting $1.3 million. Having your house, you can do what you want. You've got that freedom. It's secured financial independence, and obviously Monica and Chandler here, if they need money to send their kids to school, if they want to have vacation around the world, they can obviously do that. But maybe they need to send some money back home, they can do that as well. So they've just come away with a lot more money, and we haven't even included the rental income that was a potential for them as well. So I think when we do the numbers on this, I think it's quite clear that owning a detached over a long period of time in Vancouver, not Red Deer, Alberta, not Saskatoon, but in Vancouver, will beat even the very best investment in stocks. So when you got questions, you got comments, leave those below. Look forward to hearing from you.